Now, a big step here for Mark, if he's going to add that $30,000 to the after-tax bucket, before there's any growth or taxable growth, he'll want to roll it into that Roth bucket where he'll be able to get that tax-free growth and then the distribution in the future. Now, there's a few big questions that come up. One of them is, what time of year is the best to do this Roth conversion? And another question is, how do I know if I should even do this? What should I be testing to see if this makes sense for me? So first, what's the time of year? What's the best time of year? As with all financial strategies, there's timing and personal circumstances play a big role, right? One key consideration is market performance. In an ideal scenario, we do a Roth conversion when the market or the investments inside the account are at their lowest point. This is why we've got so much activity at Streamline Financial during temporary corrections, because there's some proactive strategies that our clients take advantage of during down periods. It's what we call the anti-fragile retirement plan. And the plan that doesn't break in bad times, but it actually substantially can improve itself. And if you want to see that, I'll include a link at the end of this video. But back to the backdoor Roth. The reason why we want to convert during a low point is because lower market valuations mean that you can convert more shares to a Roth at a lower tax cost, which can potentially lead to more significant tax-free growth if and when the market recovers. Another aspect to consider is your cash flow. This strategy requires a substantial cash contribution. It's that extra 30,000 or so if you're going to try to go for the max. And not everyone may have the liquidity to make such a large after-tax contribution. Sometimes people will build up their bank account or their taxable brokerage account to fund these mega backdoor Roth conversions. So when it comes to the best time to do this, in my opinion, since we can't time the market, or if we know if there's going to be a correction or a down period this year, I would say think about doing the conversion when you've got the cash available. If it's in the beginning of the year, that's great. Hopefully the investments go up over the year, the whole course of the year. Worst case, let's pretend you do it in January and the markets go down 10 or 20%. This means that if Mark put in $30,000 and now the value is maybe 25,000 or so. Now that's kind of an extreme worst case, but you can also look at multiple period contributions if you want to do something like that, sort of like a dollar cost averaging, where it's not a lump sum at one point in the year, but a few contributions throughout the year. Again, my personal thought here is I would get it over with and then move on, and versus trying to time and spread it out in some fashion. Because when you analyze a lump sum versus dollar cost averaging, if you look at history, it's shown that investing lump sum typically produces better results. Now let's explore some of the common misconceptions or mistakes around mega backdoor Roth conversions. One common myth is that the strategy is just for the ultra wealthy. Well, it's true that those who have higher incomes might get more benefit from this from a tax perspective. It can also be a strategy for middle income earners that's maxed out their traditional retirement contributions and they're looking for additional ways to save. The last few years before retirement are really they can be the highest income earning years for a lot of people, which could be a good time to funnel more into their Roth. Now, some important things to remember. When you opt for this strategy, you're essentially choosing to pay tax now in exchange for tax-free growth in the future. And this can be a significant advantage, especially if you expect higher tax rates or a higher tax bracket during retirement. However, this also means that you're missing out on tax deductions and the benefits of that currently. So balancing these is key. I'd say running a tax projection for yourself or with a wealth management team is a good idea. If you don't have a team that specializes in retirement strategy, reach out to me by clicking on the button below this video. And I'd love to have a call if we've got the availability. Now, another mistake is not immediately converting after-tax contributions to the Roth account. So it's this step from once you put the money in, not immediately getting it to the Roth, because delaying that could lead to some growth within the account and some of it then being taxable upon conversion. Another mistake that we see is just not paying attention to the changes in this rule and the IRS limits and the rules that come to this. Just spend a lot of time on this, work with an expert before you think about doing any of this. Don't rush into it, but there's a lot of nuance as with any financial thing. So take your time.